Good morning, Jags. This is Fahad. Today is Thursday, June 11th. As I am starting this podcast with my team this morning, the Dow futures are gapping higher. I'm gapping higher. I'm sorry, gapping lower. Kind of used to saying gapping
For so
higher these
habit,
days.
yeah.
Gapping lower by 3.1%. You can see the candle here. Uh, Nasdaq is down 180 points. So Dow down 850, Nasdaq down 180. The S&P futures down 83 points. So all three of these indices are somewhere between 2 and 3% down. S&P is more than 3% down. But perhaps the most important one, once again, is the Russell 2000 index, which is down 4.5%. Now, keep in mind that we're so close right now to reaching a 5% threshold, and the market still has about an hour before it opens. So at 5% on the Russell 2000, we're gonna have a limit down. So it only needs to go another 7 or 8 points, which is nothing for Russell given the high beta index that is. And we're gonna have a limit down in the Russell 2000 index. We haven't seen one of these days in a long time. The last time we saw weakness like this was back in April 30th, which continued for a couple more days before things started to stabilize. So just keep this in mind. I'm going to keep my thoughts this time on a high level. I want to reflect back upon what we were seeing all week long. As many of you know, and you probably saw on Friday, I issued a podcast late in the afternoon talking about we were seeing tremendous, extreme levels of just overbought conditions everywhere in the market. This was after the job report came out and everything was very, very jumpy. Market internals were quite stretched with NIMO, NYSE, the percentage of stocks trading above the 50-day, the CBOE equity put over call ratio. So I warned everybody on Friday, things were getting very, very overheated. And then we came to this week, and all week long, what we have been discussing Monday, Tuesday, Wednesday in the chat room, in our webinars, and everywhere is the extreme narrowing of the leadership. And yesterday was a huge example of that. So take a look at this. I pointed this little picture in the chat room yesterday. We're at the close. The financials were down 3.7%, energy down 4.9%. Transports, industrials, retail, real estate, everything was down more than 2%, more than 2.5%, and yet tech was up 1.7%. This was from yesterday, but it was really happening across the entire week, Monday, Tuesday, Wednesday, and yesterday was reaching quite extreme. And I also pointed out in the chat room yesterday that gold was bid, VIX was bid, bonds were bid, and the leadership was narrowing, and Russell 2000 index, where all the small and medium-sized businesses are that are supposed to be doing well with the reopenings that are happening around the country, they were the ones that were most underperforming. And we were also talked about yesterday in the chat room how the second COVID-19 case is potentially what's appearing in the front pages of newspapers, and then in Telegram I shared the Bloomberg article talking exactly about that. My point of all of this discussion is you should not be surprised that it's finally catching up to the rest of the market. You cannot have a very constructive market where the market internals are so overbought and stretched as they were on Friday, all right, with no hedging going on in a CBOE equity put over call ratio, and yet the narrowing of the leadership was so profound across the entire week. So you had a market where people were comfortably getting longer and longer the FANG names while everything else was falling, and more importantly, they did not have the insurance in place. That's what the CBOE equity put over call ratio was suggesting. So this is where we get spikes in VIX when they do happen. VIX is currently guided higher by about 14% in pre-market. So it's going to open at 31 because the hedging was insufficient amount of hedging was taking place underneath the market. And this is where the sell-offs have the tendency to become far more vicious than one want to see. So we need to see, going back to the S&P chart, exactly where we're going to go from here. Now, the natural inclination looking at a high level view on the S&P would be that this correction will possibly go all the way up until 3,000 in the S&P, because that's the major volume of a price support that comes in. And the 200-day moving average is not far off from that same 3,000 level. It has only slightly curl higher. So it seems to me that the retest of the 200-day could be in play here rather very, very soon around 3,000 level. But if we're unable to hold that 3,000 level, and we continue to slice through it like the way we were doing this back in February, because this news possibly about second wave is going to continue to surface everywhere around the big newspapers going into the weekend, and then people will be watching the data very, very closely next week. Then we'll see exactly, how far deeper this sell-off could be. In absolute worst case scenario, in my opinion, the 2,800 level in the S&P, which is another 10% below where the index is right now. That level is right over here. This is where a lot of basing formation took place. So that's the 2,800 level. That must hold at all cost, even if we pull back all the way down to that level. If we're unable to hold that 2,800 level as well, if it gets that washy, then things are going to get very, very rocky. Expect a lot of froth that we were seeing in a lot of companies that on a reopening theme jumped sharply 15, 20, 30, 40% in a matter of very, very few days. Expect the money to continue to rotate out of them. So you had a ton of retailers that ran hard. You had casino stocks, you had hotel, leisure, and a bunch of these names. They continued to run hard for a couple of weeks on expectations of reopening, but those will be the one that will get hurt the most, and the bar will be reset to a newer level, a lower level for all of them. We'll see how far down they will go. So that's where a lot of the money will come out. But there are other risks that you need to keep in mind, which is that, for example, after the FOMC yesterday, what I noticed was that the real yields, bond yields, actually turned negative yesterday. In other words, that means there's going to be pressure on the banks, and because that's a forward-looking indicator that financials are going to struggle one more time, because they're going to see their net interest margin now in the current quarter come under pressure. So it wouldn't be surprising that the banks, particularly the regional banks, come into pressure today. Now, we have discussed a couple of those recently. So, for example, OZK, remember Chronicle, you had a bearish case on this one in Jaguar Media not recently. These are the kind of banks that will come under pressure. Similarly, previously, I have presented a bear case on BOK Financial. So, and if you look at pre-market, even if you look at the big banks, Goldman Sachs is about to gap down by more than $10 in pre-market, about 5% down in pre-market. And that was the group, if you simply look at yesterday, what was getting killed the hardest after the FOMC and the press conference came out. That was the second worst performing group, financials, yesterday. So they'll be hurt the most today, and I expect that to continue, because the real yields actually are starting to move down after that FOMC. So that means we're going to be doing some shopping at some point, and my goal is continuing to buy stocks that are in the value sector rather than chasing growth where I see a lot of fraud. But we're going to be patient this time, and we're going to be looking very carefully where those entries will come in, whether they happen to be in the cyclical industrials, particularly in the defense group, that I really like. I want to get back into call options in United Parcel after I took some major profits on this one on Friday, but I'm going to be careful about where I want to step in. Where I want to step in on the call options again, similarly, we recently traded Lockheed Martin very successfully. I'm going to be watching this carefully where we step in. USCR, which is going to be the beneficiary of any kind of stimulus package that will come out on the infrastructure side. Again, I'll be watching carefully. So the entries will matter because you get a sell-off of this magnitude when nobody has insurance in play, when the CBOE equity put over call ratio is at 16-year low, right? So nobody is hedging in the market for the last couple of days. You're gonna get some big, thick red candles today. And unless we get a complete turnaround, this, it's gonna be a rough day, and we do not know yet whether 3,000 support is going to be sufficient in the S&P yet or not. Markets were just way too overbought when we were on Friday, and you could see froth everywhere, from IPOs, from junk names, even companies like Hertz and such were ripping higher 200, 300%. So just high level thoughts over here. I don't have any single stock discussion because it's rather pointless at this time unless we see where the market is heading and what lies ahead. All right, so with all of this said, let's go to Chronicle. Chronicle, you have a stock you want to discuss?
Yeah, I'll share what I was going to share yesterday. This is a trade I put on yesterday morning with lunch money, which is short Cummins. The symbol for that is CMI. To be clear, I'm not looking for a huge collapse in the stock. I think there's going to be a 15% pullback over the next couple months to around $155. So what I did was I bought September 175 strike puts. I sold 155 puts as well as 145 puts to further increase the risk reward. And my reason for this trade is the stock has gotten too far ahead of itself, and I would not be surprised to see a modest pullback in the near future. This stock used to have a lot of short interest, but it's now down to just 3% of float, and so it looks like the short sellers have been flushed out. Firstly, if we look at their most recent earnings, the results weren't great, with revenues down 17% year over year and earnings down 19%. But on the other hand, one may argue that the stock is pricing in future growth, to which I would say if we look at this chart of Class 8 truck orders, which I shared in our private chat, we can see that orders have continued to trend lower after the company last reported. So the line chart here shows 2020 numbers and the bar chart shows 2019 numbers. And what's important is in the coming week is that FTR is going to be reporting truck orders for May, which they've already guided to be at 10,000, which is still down year over year despite very easy comparisons. And on top of that, we are heading into difficult comparisons for September and October, which represent Q3 and Q4. And I mention this because Cummins stock is highly correlated to truck orders. If we look at the chart of the stock, notice how late last year around September, the stock began shooting towards near 52-week highs. And now if we look back at truck orders, notice how those orders were also ramping last September and October. So there is a strong correlation here because truck engines and components account for more than 50% of sales. Separately, if we take a look at the other image that I shared, which shows the ISM survey trends for the transportation equipment industry, we can see that the entire industry which supplies transportation has been in pretty deep contraction now for almost a year, and yet we're still not able to beat year-over-year comparisons, which is pretty pathetic. So putting all this together, when I look at how much Cummins stock has run up the last several weeks, it begs the question, what exactly is the stock pricing in here? Like you cannot tell me it's pricing in future growth, not when new orders are in deep contraction and we have tough comparisons coming up in the back half of the year.
Yeah, there is generally, from what I've noticed in this sector, having covered the transportation sector, particularly Cummins and PACCAR and a whole bunch of other transportation-related companies, is that there is a lag of about 3 to 4 months for new orders. And so when they start to show green shoot early on, you see truck or you see the improvement, the actual sales to begin about 3 to 4 months later. And so new orders is always the forward-looking indicator. And if right here in March, April, May, you're showing those red deep contractions right now, that makes this recovery sometimes, because people are going to be looking at similar kind of a trend to emerge compared to 2019. So I don't think we're going to see this kind of recovery that we saw in 2019 in August, September, and October period. Most likely what's about to happen is the current year, it comes down hard, possibly even, gets down to low few thousands, and then just flatline from there with only minor and small pickup, which will only be driven by e-commerce trends, if at all, basically in a big way. So you're short this one, and you have a chart here. Let me pull that up as well. So right here. So taking a look at technicals, you believe that this thing is going to head down to about 155.
That's correct. There's some support there, so I don't mind selling a strike there.
Yeah, so this is not a crash and burn kind of a scenario. This is mere pullback on a simple view that the outlook seems to be mismatched with what's happening in the new order growth. So just keep that in mind. Interesting stuff. Fantastic. Jay, what do you have, buddy?
Hey, Fahad, just one stock today to put on your watch list, and that would be Livongo Health. Ticker is LVGO.
Yeah.
This is a medtech medical device company whose verticals include diabetes, pre-diabetes, hypertension, weight management. It's not a stock we've covered a whole lot. Most recently on May 11th, you covered it after Q1 earnings, talking about their 115% revenue growth. Management guided to, I think, 71 to 78% growth for 2020. But the reason why I'm bringing this up today is because this week at a Stifel conference, management announced a new cholesterol solution that will be launching later this year. Now, there were no specifics in terms of pricing or the official date, but this should be a nice extension to the current verticals it has to offer. And then Stifel would comment just about the market overview in general, about how there are approximately 43 million adult Americans taking medication for high cholesterol, and then another 35 million that could benefit from medication therapy. So assuming all that, and then correlating that to current pricing for hypertension, they suggest a potential $3 billion incremental total addressable market for this new cholesterol product.
This is fantastic stuff. One to watch, because you see, this is the kind of name that I would be looking to get long if the market pulls back materially, and names like these basically get a hit. Good stuff there. Technically this looks perfect too, and I think we have seen a little bit pickup in call option activity as well. Yesterday was a power candle breakout with high volume. I think that's 55 to anywhere between $55 to $60 range will continue to be support on pullback. So this closed at 63 yesterday. Let's see if it pulls back, gives us an entry around 55, given the views that you just expressed, and then we can use a hard stop at that point, and then look for a new leg higher from that point on. So with market pullback, we may be having that opportunity coming our way pretty soon. It's good stuff. Thank you. Avo, what do you have?
I don't have a specific stock to speak of. I just want to second your commentary earlier about when the market moves a certain way, whether it's up or down, usually a lot of things go with it. So don't be surprised that even gold miners or gold and silver, maybe not specifically gold and silver, but the gold miners get sold as well, along with everything else, as you said earlier. What I'll be watching for is NIMO. I want to see how it reacts, or how the market reacts once we hit minus 40. I don't know where we're going to open at, frankly. Closed at around plus 20 some odd thing yesterday, so we shouldn't be too far from the minus 20 area, minus 30 even at this rate.
Yeah, so I just want to quickly, on staying on that topic, I just want to, on regarding NIMO, I just want to say that, NIMO, once it turns negative, it will take still a couple days for NYSE to basically start declining. And as you know, the summation index had gone all the way to 1,050, extremely high level. Now, when the NYSE summation index starts to turn south and takes out the 8-day moving average, that's when you know the trouble is on the horizon and there's a breakdown in the momentum that could potentially last for a long time. Basically, when the red line crosses the blue line. So it's not going to happen today, but it may happen if this weakness persists tomorrow, and then also early into next week. Then we'll start to see that appear over here. And as far as the just to quickly highlight the CBOE equity put over call ratio, yesterday's close, a 10-day moving average of that was at 0.45. When it was 0.47. So higher than yesterday. When it was 0.47 last Friday, it was a 16-year low close for the 10-day moving average of CBOE. And that's what I mean when I just say this, because what this means is nobody is hedging. Very, very little hedging at a time when we're hitting extremes, and that's why you get vicious weaknesses in a single day and such. By the way, I just want to quickly point out that the initial claims just came out as well. And we have another very large number, 1.5 million jobless claims filed this week. And more importantly, the continuing claims went up again. The continuing claims are now at 20.9 million versus 20 million estimated, and higher than last week. So this is basically saying that there's still tremendous large number of people filing claims. So that's what was perplexing about the May job report that came out on Friday, where it didn't make sense how things were stacking up looking at claims, and yet we ended up creating 2.5 million jobs, and turned out that there was an error that was correct that BLS pointed out itself. So these claims are still very, very high, 1.5 million. To give you an idea, the 1.5 million claims on 11th week after the pandemic started is still 2.5 times more than the highest peak that we saw during the 2008 recession. So we are 11th week into this, and we're still getting claims multiple higher than the peak that we saw in 2008. So keep that in mind. Anything else to add, Avo, or should we close out here?
No, that's about it. That's
Okay.
it. Yeah, nothing else to add. Just levels to watch. I agree with the numbers you laid out before. About 3,000-ish for the S&P, and we'll take it from there.
Yeah, sounds good. Thank you, everybody, for joining. We'll see you in the chat room shortly.